How to align your investments with your values and goals. One of the most important aspects of investing is to make sure that your portfolio reflects your personal values and goals. Investing is not just about making money, but also about supporting the causes and issues that matter to you. Here are some tips on how to align your investments with your values and goals. Identify your values and goals. What are the things that you care about the most? What are the problems that you want to solve or the changes that you want to see in the world? What are your short-term and long-term financial objectives? Write down your answers and use them as a guide for your investment decisions. Research the companies and funds that you invest in. Before you buy any stock or fund, do some homework on the company or the fund manager. What is their mission and vision? What are their environmental, social and governance (ESG) practices? How do they treat their employees, customers and stakeholders? How do they perform financially and ethically? Look for sources of information such as annual reports, websites, ratings and reviews. Choose investments that match your values and goals. There are many types of investments that can help you align your portfolio with your values and goals. For example, you can invest in socially responsible funds, SRFs, or environmental, social and governance, ESG, funds that screen out companies that harm the environment, society, or human rights. You can also invest in impact funds or social impact bonds, SIBs, that support projects that have a positive social or environmental impact. You can also invest in individual stocks or bonds of companies that share your values and goals. Diversify your portfolio. While it is important to invest in what you believe in, it is also important to diversify your portfolio across different sectors, industries, regions and asset classes. This will help you reduce your risk and increase your returns over time. Diversification also allows you to support a variety of causes and issues that you care about. Monitor and adjust your portfolio. Investing is not a one-time activity, but a continuous process. You should regularly review your portfolio and check if it still aligns with your values and goals. You should also keep track of the performance and impact of your investments. If necessary, you should rebalance your portfolio or make changes to reflect any changes in your values, goals, or market conditions. By following these tips, you can take pride in your investments and know that you are not only making money, but also making a difference in the world. One of the most important ways to take pride in your investments is to diversify your portfolio and manage your risks. Diversification means spreading your money across different types of assets, such as stocks, bonds, real estate, commodities, and more. By doing this, you can reduce the impact of any single asset class on your overall performance and protect yourself from market fluctuations. Managing your risks means being aware of the potential losses and gains of each investment and adjusting your strategy accordingly. Some factors that affect your risk level are your time horizon. How long do you plan to hold your investments? Generally, the longer you invest, the more risk you can afford to take, as you have more time to recover from market downturns. Your risk tolerance. How comfortable are you with volatility and uncertainty? Some investors are more willing to accept higher risks for higher returns, while others prefer lower risks and more stable returns. Your goals. What are you investing for? Different goals may require different levels of risk and return. For example, if you are saving for retirement, you may want a more conservative portfolio than if you are saving for a vacation. To diversify your portfolio and manage your risks, you need to follow some basic steps. Assess your current situation. What is your net worth, income, expenses, debt, and savings? How much can you afford to invest and how much do you need to achieve your goals? Choose an asset allocation. How much of your portfolio do you want to allocate to each asset class? This depends on your risk tolerance, time horizon, and goals. A common rule of thumb is to subtract your age from 100 and use that percentage as the amount of stocks in your portfolio. For example, if you are 40 years old, you may want 60% stocks and 40% bonds. However, This is not a one-size-fits-all formula, and you should adjust it according to your personal preferences and circumstances. Select your investments. Within each asset class, how do you want to diversify further? For example, within stocks, you can choose between different sectors, industries, regions, market caps, styles, and more. You can also use index funds or exchange-traded funds, ETFs, that track a basket of securities and offer instant diversification at a low cost. Monitor and rebalance. How often do you want to review your portfolio and make changes? You should check your portfolio at least once a year and rebalance it if it deviates too much from your desired asset allocation. Rebalancing means selling some of the assets that have increased in value and buying some of the assets that have decreased in value. This helps you maintain your risk level and avoid being overexposed or underexposed to any asset class. By diversifying your portfolio and managing your risks, you can take pride in your investments and enjoy the benefits of compound interest over time. Remember that investing is not a sprint but a marathon, and that patience and discipline are key to success. One of the most important aspects of investing is to monitor your performance and learn from your mistakes. In this section, we will discuss some tips and tricks on how to do that effectively. First, you need to track your portfolio regularly and compare it with your goals and benchmarks. You can use online tools or apps to help you with this task. For example, you can use Personal Capital, Mint, or Yahoo Finance to see how your investments are doing and how they compare with the market indices. Second, you need to review your performance periodically and analyze what worked and what didn't. You can do this monthly, quarterly, or annually, depending on your preference and time horizon. You should look at the returns of each asset class, sector, and individual stock or fund in your portfolio and see if they met your expectations or not. You should also look at the fees, taxes, and commissions that you paid and see if they were worth it or not. Third, you need to learn from your mistakes and make adjustments accordingly. You should not be afraid to admit when you were wrong and cut your losses when necessary. You should also not be too attached to your winners and take profits when appropriate. You should always have a reason for buying or selling an investment and stick to your strategy. You should also diversify your portfolio and rebalance it regularly to maintain your desired risk-reward ratio. By following these tips and tricks, you can take pride in your investments and improve your skills as an investor. Remember that investing is a journey, not a destination, and that you can always learn from your experiences and grow from them.